The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Alex Steele. Well, that was an intense 48 hours in the markets.
And we still have an hour to go.
And we are moving to the downside here. Let's take a check-in on where we are. So this is an S&P futures chart because I felt like it was worth illustrating the last 12 hours that we've seen. So right here is when you had Asian markets open. So you obviously saw a little bit of a gap down from where we were on Friday. Then you picked up steam to the downside. Then around 2 o'clock, European stocks opened around 4 o'clock. You end up getting the UK stocks opening. Then cash futures opened here. They hit the low by around 9:30 when we opened. And then you had the ISM services data that wasn't as terrible as maybe it could have been if you compare it to the ISM manufacturing. And it's been a slow climb upwards from there. Now we are rolling over a little bit here. The question is, where do we go from here? There was clearly a signal here to buy the dip, but there are a lot of systemic funds right now in the markets as well, Scarlett, and the call for them is to continue to sell into this pressure.
So we're going to get into all of that in today's show. But the takeaway from today's price action is less bad. The VIX spiked to as high as 65 just an hour before the U.S. markets opened, then easing to the low 30s, although still elevated from last week's 16 and change. This, of course, as equity indexes pared their initial losses, and the rally in U.S. Treasuries, well, kind of faded. Ed Yardeni of Yardeni Research calls the initial sell-off overdone when he spoke this morning.
That's conceivable that this carry trade unwind becomes some sort of financial crisis that in turn leads to a recession, but that's not where my thinking's at.
Now, you mentioned it, Alex, but the latest data showed there's no recession yet. Today's read on the services sector points to an expansion in the biggest part of the U.S. economy, with even orders rebounding. It did provide a bit of relief after Friday's weak payrolls number and the increase in the jobless rate. Still, big tech remains the weak link. NVIDIA falls to a 2.5-month low on a report that its upcoming AI chip will be delayed due to design flaws, while Apple dipped below $200 a share as Warren Buffett's Berkshire Hathaway reduced its stake in the company, a sign that he sees stretched valuations.
All right, well, let's kick it off right there with Barry Bannister, Stifel Chief Equity Analyst. Now, Barry has been calling for a 10% correction on the S&P 500 by October. Barry, is that this correction?
It's begun. I would fade this rally, this intraday rally that we've tried to have. Too many technical levels have broken. The Fed really is sort of trapped. You know, they typically, from last hike to first cut at 7 months, by September it'll be up to 14. So it's probably too late for them. And our specific forecasts, as you look at second half GDP and even core PCE on a year-over-year basis, would point to disappointing data that would culminate with a peak or a crescendo in October. I would fade this rally.
You mentioned too many technical levels broken. Which ones are you looking at and which ones portend more damage to come?
Well, I was particularly interested in how financial conditions have rotated up to tightness and how high yield and investment grade spreads on a percentage change basis are up more today and recently than the S&P or NDX or any other index is down. So we're seeing a tightening of financial conditions, which really brings into question the price-earnings ratio of the stock market at large. It got too frothy for too long. Mm-hmm. Equal-weighted was much better value, but cap-weighted with the AI boom just got overdone.
So if you want to fade the rally here, when would you buy fade the rally, when would you then buy the sell-off, and where would you buy that sell-off?
We're going to have to digest the fact that our GDP models are saying that we're going to come close to a zero GDP by third quarter. And, it may only last a quarter, and it may be that we pick up again, but we look at specific subcomponents of GDP, and it doesn't look great. The other thing that we're looking at is that year-to-year core PCE will probably break 3, just barely, 3.1 in the fourth quarter. And when that happens, I think it's going to really make it hard for the Fed to justify dramatic cuts as they look out to 25 in futures. So nothing really looks great right now. I would just take the summer short.
Nothing looks great right now, but when it comes time to start picking up some pieces, where would you do that? Would it be by size, for instance, small caps over large caps? Would it be in certain sectors, the defensives, whether it's utilities or consumer staples? Or would you look at different geographies, Barry?
Well, for a few months, we've been urging investors, because we saw this correction coming, we've been saying buy the defensive value, which was utilities, healthcare, and staples and quality. And with my colleague Thomas Carroll and Miles Matico, we came out with a lot of work on that. So we have been in the right kind of defensive posture for a cyclical to defensive trade. But if we have a rally, let's say after we make our low around October, it's typical of investors just to go back to the old winners. Now, it won't last very long and it could fade very badly, but typically you don't want to fight the consensus psychology if there's any sort of power rally, even if it doesn't last very long. But let's focus on getting to the bottom first before we try to come up for air.
So when does sort of a healthy correction that some are calling for become an unhealthy correction? How do you judge that?
A typical correction that's a mid-cycle slowdown might be in that 12-13% range, which would put us at 5,000 off the July high for the S&P 500. So 5,000 there. High teens for the NDX because of beta. If it goes beyond that, then it's more like discounting a recession where the drops are much higher, much larger, and that would be obviously bad. So we're thinking it'll bottom out there around 5,000, and I certainly wouldn't jump in front of it here because things are going to deteriorate for both the economy and the Fed's ability to argue that they're going to rapidly get back to 2%. We're more bullish than most people on supercore housing because of all tenants and certain subcomponents that lead us to think unit labor costs are going to go up as productivity cyclically fades in the back half. So it's a very specific model, but it's enough to cause us to have pause.
Barry, how would you explain the turnaround in treasuries? We now have prices at the short end of the curve down. So, you know, we're no longer seeing big declines across the curve. What do you make of that?
We did have a bull steepener there that probably just overshot a little bit. It is unlikely that the Fed's going to give us 50 basis points in a sudden move in September, unless we just fall apart on the payrolls data a couple weeks before. So if we look at that, it just got overdone perhaps, and we are still in a period where the Fed needs to cut, and the question is how long the market and the economy will wait.
I mean, if we were worried about growth, though, why isn't the back end selling off?
Well, longer term, I think that there's going to be a higher equilibrium yield on the 10-year TIPS yield, the real yield. It really prices off 36-month rate futures adjusted for the 10-year break-even inflation. The oil price, perhaps it's just looking through some of the geopolitics, but oil hasn't collapsed. A collapse would be somewhere below or at $60 a barrel. It has not collapsed, so that's usually a sign that you can maintain a break-even level of about 2. So when you look at it, there's not a lot of downside in the 10-year yield just because of the Fed's normalization, longer-term inflation, and where you would price the instrument. Last comment would be, if you look at the long-term expectation of short-term rates, it tends to be a little bit below or close to, on a normal level, nominal GDP. If the United States can grow at 3 or 4 nominal, then we're not going to see the old days of 2% unless we're in a recession, which is not bullish anyway.
Okay, great perspective. Barry, really appreciate your joining us today. Barry Bannister is Stifel Chief Equity Strategist, and he had been calling for a 10% correction. Now, coming up on the close over the next 2 hours, Mohamed El-Erian, Bloomberg opinion columnist and president of Queen's College, Cambridge, joins us with his perspective on this risk sell-off.
Plus, a big bright spot. You got shares surging on news of a potential buyout from Mars. We're going to speak to an analyst about what could be one of the biggest deals of the year in the best performing stock in the S&P, Kellanova. And earnings season rolls on. We've got CSX, Lucid, Hims, and Palantir among the companies set to report after the closing bell. We're going to break down what investors should be on watch for from all those results. All that and more coming up. This is The Close on Bloomberg.
And we know that the Fed is going to just be increasingly focused on the employment side of their mandate as inflation comes down, as unemployment is rising. We do think they'll be pretty reactive to that and maybe even feel a little bit behind the curve by the time we get to that September meeting.
That was Citi's Veronica Clark on Friday. That's after the firm adjusted their outlook, saying they expect two 50-point basis point cuts this year, along with a quarter-point cut in December. And Citi's not alone, because since then, the calls have gotten louder. And today, the conversation seemed to be about an intermeeting cut, because that's how bad things were. The curve disinverted, and then everything changed over an hour. Joining us now is Chief Correspondent Liz McCormick and Bloomberg International Economics and Policy Correspondent Michael McKee. Liz, we really went from maybe we're not going to get a soft landing to lots of cuts to intermeeting cuts to a curve disinversion to now the steady as she goes. Now we see a higher 2-year. What happened?
Yeah, wow, right? A lot. I mean, it's first of all, when panic starts, we've all been through this before, it just escalates, right? So that's why we came in, it happened in Asia overnight, into Europe. But then Mike and I were talking about the ISM services. And, had that been bad, we might be saying we're still in the free fall curve, majorly inverted, disinverted still. But those numbers were a little bit better. So I think it gave people a little bit of a reprieve to maybe regroup and think, is the Fed going to do this? That intermeeting cut pricing way came down. So I think it was a chance to regroup and think and it kind of calmed things. Not for equities, really. They're still down. But the bond market, now we're still inverted in the curve after being positive by a little over 1 basis point.
And Austin Goolsbee, the Chicago Fed president, Mike McKee, has been making the rounds. I know you were one of the people who spoke with him on Friday, and he's cautioned for everyone to stay calm. He spoke again today, and his message hasn't changed that much. So from the perspective of Fed officials, they're not anywhere where the market seems to be when it comes to interpreting this data.
No, they're not. The Fed's view is if you can trade, then we don't care if that trade loses you money. Our job is to make sure that the markets work, and if they're working, then we don't really have a problem. And when you consider Goolsbee is one of the doves on the Fed, the fact that he isn't screaming for any kind of emergency action tells you that the majority of the Open Market Committee is not going to be looking at this. An intermeeting cut, unless we had some sort of interruption in market trading, isn't going to happen. And I think it's way too early to say a 50 basis point cut is going to happen in September, because we have a lot of data between now and then. Just one small example, the jobs report. A lot of people think that, there were a lot of people who didn't go to work because of weather. Mm-hmm. Now, it may not have been a hurricane. It may be a lot of different reasons, but that could easily reverse. And then you get a big number in August. You just don't know.
Well, but to that point, WIRP is still, the markets are still pricing in like 115 basis points of cuts so far this year. We started the year with like 6 basis points of cuts kind of priced in. So the Fed has to give credence to the data, but at the same time wanting to walk that back, because they're not going to want to see, 5 cuts priced in, are they?
Well, no, they're not going to believe in 5 or 6 cuts unless the economy is falling off a cliff, unless we're really in need of that sort of thing. If you spread it out, you could see that happening if we go into 2025, if they want to get down to the 3 to 4% range to get to neutral. But it's not going to happen all at once unless there's a real shift in the paradigm of the news. And the fact that the stock market fell today convinced some equity investors there was a shift in the paradigm. But when you look at the reaction in the bond market, for example, you don't see that. So I think this is going to be just a waiting game for equity market investors. The Fed isn't going to be anxious to come out and reassure people because they don't want to give a lot of credence to this. Jay Powell's not till the 23rd. So we probably won't see a whole lot this month until, except for the things like retail sales numbers that might give us some clues. But beyond that, it's going to be a waiting game during August.
So, Liz, it feels like most of the panic was during overseas trading hours. In Japan, in Europe, you had the unwind of the yen carry trade based on the Bank of Japan's action last week. And when U.S. trading hours began, a little bit of calm seemed to have returned. Is that the way to think about it here?
Well, I kind of think the calm didn't really return until the ISM data came out. You know,
so in a holding pattern until then.
Yes, I mean, kind of in a holding pattern, but I think you're right. The carry unwind just escalated everything. And even I was thinking about Fed Goolsby's comments. Like, I think not today, but the other day he spoke and he said, to your point of they were pricing so many cuts before, he said, hey, remember the market was pricing in like 7 cuts at the start of the year, like kind of we were calm, and that didn't pan out. So I think they have to look through that. But I think the bond market took a little reprieve. We also have a bunch of supply coming this week. You know, the refunding supply, which is a lot of paper, 3s, 10s, and 30s coming. So with the data kind of giving them a little bit of a chance to stop, now you have to figure out we have to take down this supply. And the only real key data, I mean, not to minimize any of the other ones, but nothing major besides unemployment claims on Thursday. So today's Monday. We have there's going to be a lot of waiting. And I would say that, you know, we have a lot of time until September. But, you know, if the data turns, the Fed, you know, Craig Torres in D.C. always says the Fed will do whatever they need to do. So if by then they need to go more, they will. But for now, they're not going to panic.
We haven't gotten to that point yet, in other words. Liz, really appreciate your joining us on set here, along with Michael McKee, Liz McCormick, and Michael McKee on the Fed and what it does next. Now, coming up, shares of Kellanova rising to intraday highs not seen in more than 35 years, as the snack company that was spun off from Kellogg's is now potentially in play. More analysis to come in Top Calls next. This is The Close.
All right, time now for Top Calls. A look at some of the big movers on the back of analyst recommendations. Now, let's start with some home builders. Yeah, KB Home, Toll Brothers, and others getting hit today with sell ratings from Seaport Global. The analyst says the risk to return outlook for the builders is now to the downside. He sees cyclical risks from interest rates and margin risk from new and existing inventory in the housing market. Toll Brothers, for example, off by over 5%. Next up, you got Mobileye, downgraded at Daiwa Securities to neutral from buy. Mobileye, which makes software for autonomous driving, slashed its annual forecast last week. Now, the move that the analyst wasn't particularly a fan of. He also raised concerns about production and lower cost competitors over in China. And let's end things on Kellanova. A different story here. The company responsible for brands like Pop-Tarts and Pringles may be added to the roster of snacks for Mars as talks between the two companies get underway. Analyst Nick Modi at RBC Capital Markets telling investors there is something here with Kellanova and Mars. He looked at his recommendation to outperform. Kellanova up by 15%, one of the few stocks in the green today, Scarlett. Those are some of our top calls.
All right, and let's continue our conversation on Kellanova. The shares, as mentioned, having its best day in 36 years on the heels of that M&A speculation with Mars. Both companies, by the way, declined to comment. Let's get some sell-side analysis from Erin Lash, Director of Consumer Equity Research over at Morningstar. Erin, does this potential tie-up, make sense to you?
Yes, there is merit to the potential tie-up. Obviously, we're dealing with a market where growth is slowing, particularly given the fact that we're up against weakening consumer spending. We've faced multiple quarters of substantial inflation-induced price hikes. And so growth has been much harder to come by across the packaged food realm. And so adding a portfolio of brands that are anchored in snacking and have significant exposure to emerging and developing markets would boost the growth prospects for the likes of Mars.
Do you think that there'll be other bidders, Erin, that could come in that could have a good tie-up here?
I think that that's a very tough question. There have been significant concerns around antitrust for quite some time within this space. You think about when Hostess was on the block about a year ago, there were a number of players that were out of contention just because of the significant overlap in their portfolio. And so it's unlikely that there are a substantial amount of bidders that could emerge for these assets, given those potential hurdles.
Erin, do you think the market turmoil we're seeing is going to affect negotiations or discussions right now between Mars and Kellanova?
I think that that's very hard to say. We have long viewed Kellanova's stock as being undervalued, and we didn't think that the market fully appreciated the strength of the focus on, like I said, emerging markets, snacking, that Kellanova had really honed over the last several years. With the pop in the share price today, we do think the shares look more fairly valued. But whether outside forces impact any discussions going forward, I think, is tough to call.
So, Erin, what strikes me if I think of snacks like Pop-Tarts or Pringles is GLP-1 drugs and sort of snacks like that coming under pressure as GLP-1s really take the stage. How do you view then a potential tie-up? Like, is that offensive then or defensive?
I think it's a combination. You think about these packaged food companies, they have faced a rash of headwinds over the last several decades from varying diet trends and fads, changes in preferences from a consumer perspective, particularly along the lines of health and wellness. And through that all, they've been able to invest significant resources between research and development and subsequently marketing to ensure that their portfolio evolves and aligns with evolving trends. And so we see this as moving down the same path. We think that these firms are maintaining and prudence and objectivity in terms of what they're seeing from consumers and what consumers are after. And we expect that the portfolio of offerings will evolve in that regard as well.
If these discussions don't get anywhere, if they're not productive or they stall out, Erin, and Mars is still in the market for a snack company, where else can it go to? I mean, is PepsiCo or Campbell Soup looking to sell some of their snack businesses or snack assets?
Not that we're aware of. Pepsi has long talked about the strength of combining the beverage business with their snacking operations. Campbell Soup has again been focusing over the last, call it 6 years or so, on streamlining their portfolio in terms of meals and beverages and snacking and leveraging to grow that mix as well, particularly within the U.S. market. Hershey has the outside interest of the Milton Hershey Trust. And so that, essentially takes that off the table. So there aren't a ton of major players that look to be options.
Hey, Erin, we appreciate it. Thank you so much, Erin Lash over at Morningstar, joining us. And Kellanova isn't the only stock that's up today, Scarlett. There's a couple others in the green. You got onsemi, Tyson Foods, and here you go, CrowdStrike. That's a change among the best performers. But Tyson seemed really interesting because that was fundamental. They raised its guidance in chicken, and that has helped support the company. Yeah, beef and pork might have their own issues, but chicken doing well, and so the company's doing well.
Yeah, overall, better chicken and pork results. Beef, like you said, definitely a weak link here. What's interesting, of course, is also with CrowdStrike. This is a company that's lost a lot of ground lately because of all the news with the outage of Microsoft, so it's a little bit of a rebound play.
A little bit of relief rally there. All right, coming up, more analysis for the market. Our conversation with Scott Chronert, U.S. equity strategist over at Citi. This is The Close on Bloomberg. We're about half an hour away from the close of trading. We had the S&P down over 3%. Some of the worst movers in the S&P, you're looking at them. You've got Amazon, Estee Lauder, Allstate, Cigna. It's kind of a hodgepodge, but it's a continuation of what we've seen since Friday. I mean, this is the worst day for Amazon since Friday.
Yeah, and that's on the heels of its results, which, were not that great from where investors stand in terms of their investments and the payoff. But what's interesting among all those names is they're all consumer facing, and there are a lot of question marks about the consumer and how strong the consumer is heading into the end of the year.
But then you got the SLOOS data out at 2 o'clock, and that was okay. Like, that did not point to any kind of a hard landing.
The data today has been okay overall.
Yeah, that's true. So that's a good perspective, right? Because if you look at the overall for the S&P, it's still up almost 9% on the year. That doesn't spell a catastrophe, but it does spell a shift. The year-end price targets, for example, for the S&P are still relatively bullish. We haven't seen any sort of downgrades on that. So we wanted to get the pulse on the market with Scott Chronert, U.S. equity strategist and global head of ETF research over at Citi. Hey, Scott, how would you understand and categorize the last 48 hours of trading?
Well, I think probably what I'd focus on is an unwinding of positioning that going into Q3 was pretty strong and confident and is now coming into question. So specifically, if you look at the way we characterize the three forces at work in the market over the past couple of months, first has been the AI growth tailwind, which is manifested in the mega cap growth part of the market doing quite well. The second has been an ongoing view that soft landing is becoming increasingly the base case, which has allowed for a Goldilocks setup for many investors. And then the third, obviously, is how one thinks about election outcomes and impacts. And there, I think the early read on the Trump lead in the polls set up for a positive equity response around deregulation and so forth. All told, those three drivers of positioning are coming into question right now.
They're coming into question right now, and the jobs report on Friday is a big reason why. That kind of got people thinking again that the labor market is deteriorating a lot quicker than the Fed may have appreciated. Liz McCormick was just on saying that this week's data is really limited to the ISM services we got today and jobless claims on Thursday. And on the earnings front, it feels like we don't get anything significant until NVIDIA at the end of the month. So until then, what's going to be the catalyst that you're paying attention to?
Well, we're watching the positioning and we're saying, hey, look, we have to let this unfold and play out for a while, right? So to the degree that investors were pointed down a fairly constructive path, and a lot of the premise for that is now coming into question, we have to allow some time. So the way we had framed it going into Q3, actually, we had lifted our target to 5,600 for the end of the year, which gave us a couple of percentage points of upside. But we were really saying, hey, look at, there's a lot that's extended here. We have to allow for a 5 to 10% pullback. We're getting that 5 to 10% pullback. We're right at about 5% now. And I think what we have to just assume in here is that the questioning continues, the uncertainty continues, and with that, some unwinding risk. But under the surface, color is still quite constructive on the U.S. equity fundamental setup. So we think that the S&P is still beating to a slightly different drummer in terms of a Wall Street approach versus Main Street in the broader economy.
So just to be clear, 5,600 is your target. Do you stick by that number and just how we get there is different?
Yeah, no, I mean, look at, so we had gone to 5,600, as we hit the midpoint of the year, and our call was very clear. The risk reward isn't super fantastic from that starting point. Allow for some of the excesses to work their way off. We thought the Q2 reporting period would be a trigger for that. We've seen some evidence of that. As market pulls back, you begin to set up a better risk reward setup into the end of the year. Now, somewhere in there, we're presuming an increase in volatility around the elections. And then as you get through the elections, usually there's an alleviation of that uncertainty coming out the other side. All told, we think this pullback ultimately becomes a buying opportunity, but we do need to let the dust settle in terms of this repositioning angle that I keep coming back to.
We talk a lot about the election, and of course, there's a lot about positioning as well. But I know that you and I were talking earlier about how, Alex, there's a lot of people trying to get ahead of thinking there might be a change in administration, or certainly there's going to be a change in the leader at top, but how they want to position for potential tax changes as well.
Well, that's right. It's really changes in capital gains tax. Like, do you need to kind of get ahead of that, which brings me to kind of Buffett and what happened with Apple. Hey, Scott, can you walk us through what the election might be playing out right now in markets also?
So the way we've been thinking about election, a little bit different from many. We've been saying that both candidates, or parties, if you will, are equity negative. We've focused in on tariffs and taxes as the two main decision points. While we all care about social issues, they're a little bit less impactful on fundamentals. So where's the biggest fundamental issue? With Trump, it's how you incorporate tariffs, and there our concern has been that would be fundamentally disruptive to earnings. As Vice President Harris moves up in the polls and you have the Democratic profile now kicking in, there's, in our view, increasing burden on pushing tax rates higher to offset a lot of other spending initiatives. And in that scenario, that's potentially a negative for U.S. equities as well, as we've been living in sort of a lower tax rate regime over the past several years. So in both cases, we have issues with the candidates. There are some flip sides. With Trump, you get deregulation and his potential push down lower taxes, but we'll take the deregulation as an offset to tariff concerns. With Vice President Harris, we're still looking at that spending inertia, which kind of keeps the fiscal accommodation part going. But if you pay for it via higher taxes, what you do then begin to do is cloud the S&P 500 fundamental picture, as well as with other parts of the U.S. equity market.
Got it. Thank you for explaining that. And interesting that both candidates are equity negative. Having said that, I know there's a lot of discussion. I'm sure clients are asking a lot of questions about the elections and the potential impacts. But to what extent are they already positioning for it? I feel like it's more discussion and thought operations right now than active positioning.
I think there's a lot of discussion, and there's probably some positioning or hedging put on around Trump trades, Biden trades, now Harris trades. Got that. But in terms of an aggregate portfolio positioning around the election, I don't know that we've seen that in aggregate just yet. It's quite interesting. Again, among the backdrop issues that we think we need to contend with next year is the growing deficit situation. And a concern we've had has been that you would see a backup in interest rates. Let's call it the bond vigilantes returning into the spectrum here, as investors are dealing with an ongoing new supply of U.S. Treasuries. You turn around and look at what's happening with 10-year yields right now, and it's like that issue seems to be off the table relative to more recession-type concerns. So we're back and forth. I think right now the election's probably taking a little bit of a backseat to what's happening in terms of the underlying economic circumstance and the Fed. But I think as we go from now into the end of the year, we have to remain centered around a view that, hey, look at this is going to be an evolving, changing landscape that we're going to have to keep adjusting to. From our perch, our ongoing focus is on S&P 500 fundamentals in particular, and there we think we're still in very good shape.
Great stuff, Scott. Really appreciate your joining us, giving us your perspective. Scott is U.S. equity strategist and global head of ETF research over at Citi. And you think about this in context, Alex, the changes over the last couple of days. We've gone from no landing to soft landing to hard landing. And I think today we've pulled back into soft landing given the ISM services and the SLUs report.
But you have to wonder, too, what does it actually mean for the equity market? The S&P is still down by about 3%, but there's still a lot of systematic funds out there, like CTAs, vol funds, that the signal's still going to be sell for them. So even if you get a rally tomorrow or a dead cat bounce, like, is it just that? And the selling's just going to prevail, particularly when you layer in liquidity and you layer in seasonality.
Yeah. So are the robots taking over? Is that what you're saying?
The funds of this, I don't know.
Yeah, kind of robot-y.
Maybe, I don't know.
All right, we've got much more coming up on this market sell-off. Manic Monday, and that's what we've been seeing all day. Looking at the VIX, spiking to a record earlier, right now at about 37 and change. We're going to break down the VIX's moves next. This is The Close. Wall Street's famous fear gauge surging as much as 42 points, and the biggest one-day spike going all the way back to 1990. Abigail Doolittle has more. And look at that price action there on the VIX, right? It's come back down to a seemingly reasonable 37.81, but at its high, 65.7.
Pretty amazing, really. And it's just a sign of the uncertainty in the system, that the stress in the system, investors getting nervous. We just 2 or 3 weeks ago had this VIX at the all complacent 12 level. And then on the attempted assassination of Donald Trump, it ticked a little higher. And then on the speculation that Joe Biden may not be running, then it went up to an 18 or 19. So before these gyrations that we're seeing now, there were actually signs that folks were starting to get nervous. And I connect that back to the yen. I know everybody's talking about the unwind of the yen carry trade, but the yen did start to strengthen around July 9th. That is also the point where you started to see the Nikkei come down, the NASDAQ 100 come down. For some reason, these options traders were a little bit slower to capture what was going on. And so it was in that complacent level, but that really went away today. We're now in backwardization, which means that the VIX spot much higher than the curve, although the whole thing is elevated above a 20.
I love that you brought that up. I was harping about this on the meeting. It's just, if you look at how backwardated that curve is in such a short amount of time, and you look back just from a week ago, if you check out the CCRV function, you can show the difference. It's unreal.
It's unreal. We actually have a terminal chart that we can show where it just shows the spot going right up through the curve. And the curve had been elevated all year because of the election, that uncertainty, but now going super high. Now, it's interesting. 50 Cent, our friend 50 Cent, who, of course, not the trader, or it is the trader. I was going to say, of course, not the singer. But 50 Cent has a big trade in the market right now, and he's had it for months. And these are call options. I think it was a 40 for the October level. And actually, this is not exactly that chart we were talking about, but maybe we do have it. I think it's BTV 20, which will show that curve.
We'll pull it up.
But he apparently option volume right now is relatively light. So I think that this is a prelude of more to come. The VIX may come back in. It's clear that the system is under stress. I'm hearing that Japanese banks, that was a big part of the sell-off, and that there's fears that the plumbing is stressed over there. If that's the case, if this turns out to be systemic, it could really get kind of ugly, but it may take time. But the fact that we're seeing it in stocks, bonds, commodities, currencies, and this VIX, yeah, it's problematic.
Yep, and then sort of what the contagion for that is. All right, Abigail, thanks a lot. We really appreciate that. Abigail Doolittle joining us there, because if you're a vol fund and then all of a sudden vol goes up a lot, what do you have to do then to readjust, right? That's a VAR shock. That's a value at risk shock. And then you have to adjust your portfolio. I can't imagine that we're done in just 48 hours.
It just goes to show that one thing happens and the ripple effects continue, even if that first thing kind of calms down and everyone feels like, okay, we've repositioned adequately, but there's a lot of follow-on moves that we haven't completely anticipated yet.
Also, if correlation rises, that then increases the VIX also, which then increases correlation risk. And it's sort of it just feeds itself a little bit.
We didn't even get into the VIX of VIX yet either.
No, and that's a whole lot of bonkers. All right, well, coming up, we're about 15 minutes away from the closing bell. We're going to count you down. Jason Pride, Chief of Investment Strategy and Research over at Glenmede, will be joining us. You're looking at S&P still off by about 3% on this historic Monday. This is Bloomberg.
Core PCE will probably break 3, just barely, 3.1 in the fourth quarter. And when that happens, I think it's going to really make it hard for the Fed to justify dramatic cuts as they look out to 25 in futures. So nothing really looks great right now. I would just take the summer short.
That was Barry Bannister, Chief Equity Strategist at Stifel, kicking off the show, talking about how nothing really looks great right now. It's true. You look at the S&P 500 and its 11 sector groups, everything is in the red. We came in this morning knowing that it would be ugly given the price action overnight.
Yep, could have been worse though, I guess, if you took a look at where we were at like 8:30 this morning. You had the S&P now down by 3%, but it's not worse than that. But it's still a brutal kind of 42 hours if you were long equities. Interestingly enough, the cyclical sectors in the S&P are the least bad. Like industrials, energy, consumer staples, real estate kind of smack in the middle there. And the Russell is down, but it's not massively underperforming. It's relatively in line with the S&P, down 3%.
I think it's all in context, right? Because if you just looked at this without knowing what we had earlier today, down 3%, this is pretty bad.
Yes.
This is a Monday meltdown. But given where we were at 4 in the morning or at 6 in the morning or even at 8 in the morning, this could have been a lot worse.
100%. And like the VIX, it's only at 50, but it was at 60. But again, from where we were a week ago, this is quite an adjustment. You really have to rethink how you manage your portfolio. It's a paradigm shift, really, and you got to roll with it.
Well said. All right, so let's get some more market analysis and bring in Jason Pride. He is Chief of Investment Strategy and Research over at Glenmede. Jason, what do you see in terms of this paradigm shift? There's an unwind taking place in several ways. What stands out to you?
Well, first of all, Scarlett, thanks for having me on. This is very much what we think of as a much-needed market correction. The markets have gotten a bit overvalued. The optimism was sitting a little bit high. To have a reset like this, 5 to 10% in magnitude, I think we would be a little bit hesitant to call this a paradigm shift. Okay. Reality is, on average, we see 5 to 10% market corrections occur about 1 to 2 times every given year. And in majority of those instances, we actually see markets go on to new highs during those years. That doesn't happen all the time. Some of those times the markets end up down. And the other thing to think about is this came about after we had a 15% run in the S&P 500 for the first 2 quarters of the year. Through the mid-year point, we were up 15%. So to give back 5% plus, it actually still means that the market is up, mid-single to upper single digits at this point in time.
So does that, okay, if it's not a paradigm shift, do you have to buy the dip?
I think you have to be careful in buying the dip. Depends on how you're positioned coming into this. We are in the late cycle of an economic expansion. We don't think last week's reports indicated an impending recession. We think this is an economic slowdown at this point in time. Recession risks are there, but they still haven't gotten pronounced in nature. At some point here, this will be a buying opportunity. We would recommend that investors kind of sit back and look at this and say, okay, there's going to be rebalancing opportunities in here in the portfolio. Probably before I came into this, my portfolio is probably overweight equities. At this point in time with this move, my portfolio might actually be more in line with targets. If I'm a little bit light, I'd probably start nibbling, but I'd take that nibbling slow because I don't think we've had this dust settle as of yet at this point in time. There's a lot of technicals involved, including what's going on with the yen carry trade. A lot of unusual things in the markets. It just may take a little bit of time for the dust to settle.
All right, and of course it'll take more data points as well. I'm thinking about the fact that we're still only midway through the earnings season. Yes, we've gone through the big banks and through the biggest of the big tech companies, except for Nvidia, but we still have consumer companies to go. We still have a lot of the industrials like Caterpillar, which is due to report tomorrow. So there's a lot more data points we're going to get. How much do earnings matter in the coming days as we sift through all these shifting positions?
I think there's a handful of things that matter. One thing is earnings. This quarter, next couple of quarters are probably going to be a little bit better earnings growth for the S&P 500. Analysts have baked in higher numbers. They'll probably come in a little bit lower than what analysts had expected, but generally better growth than what we saw the prior quarters, say 3 or 4 quarters. We're getting better as we pass through the year. In addition to that, we need to keep our eyes on consumer spending, the employment data as it continues to evolve. We get weekly jobless claims prints, as well as manufacturing sentiment indexes, which we think are pretty key. Right now, those numbers, look, they're on the margin. That economic data is a little bit soft. It's not at a point that it's recessionary in nature, but it is on the softer side, indicating growth will probably be, from an economic standpoint, a little bit lighter in the back half of this year, even though the earnings numbers might be a little bit better.
So, Jason, how would you categorize what we've seen so far in the earnings season? Like, it clearly hasn't shown like anything falling off a cliff, but there are some clear weak points. What have you noticed?
Look, it's been stronger growth than what we've seen in prior quarters. But in terms of the actual reporting season relative to expectations, I would say it's been mixed, right? We've had upside and downside surprises with stocks rewarded differently on different sides there. Probably one of the interesting things that's happening that I've been hearing more and more about is a little bit of skepticism surrounding AI and how quickly those investments will pay off and profitability start to seep into the narrative. We actually think that's, again, a healthy thing for the market to go through. The optimism surrounding AI was a little bit pronounced. Historically, technology cycles have seen waves of hype, followed by a wave of disappointment, followed by a wave eventually down the road a few years later that ends up being ultimate realization of the initial hype, just perhaps not on the pace that was originally expected by investors when they were very excited.
That's a lot of waves you just described. Jason, final question to you. Warren Buffett, we learned that Berkshire Hathaway this weekend cut its stake in Apple by half. We also learned that in the prior weeks, it had been steadily reducing its stake in Bank of America, and it was the biggest shareholder in Bank of America. What does it say when you've got the world's most famous value investor pairing his positions in long-term investments like Bank of America, like Apple? What does it say about valuations overall?
Look, Berkshire Hathaway is a value investor. He's going to look at the market from perspective through a valuation lens. When he does that, he's going to look around and he's going to see a lot of large cap stocks actually sitting at the upper end of the valuation range. I wouldn't say all of them, but certain ones are definitely going to stand out. Some of the tech companies are going to be the ones that stand out. So he's probably going to be, or his operation is going to be more willing to shave those sort of positions. When we look at the marketplace, we see actually a pretty broad spectrum of opportunities. The higher end of the capitalization spectrum has been rich for quite some time. As you dip further down in that capitalization spectrum into the rest of the S&P 500, or even those down into the small cap indices or even indices abroad, we find more reasonable valuations.
All right, good stuff. Jason Pride, Chief of Investment Strategy and Research over at Glenmede. And he says one of the things you'll want to pay attention to, of course, is earnings. Alex, we're not anywhere close to being done with earnings season. After the bell today, we're going to be hearing from CSX, from Lucid, Hims, and Palantir. Palantir is going to have to make good on its AI narrative.
Yeah, and CSX, I mean, I love that company in terms of its macro read, right? It's still going to be more the manufacturing and not necessarily the services, but still quite good.
All right, we're moving you closer to the closing bell. Full market coverage right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day on this Monday. Scarlett Fu and Alex Steele here to take you through the closing bell. We've got a global simulcast. Let's welcome Carol Massar and Matt Miller. And in doing so, welcome to our Bloomberg Television, radio, and YouTube audiences worldwide. Manic Monday. We're going with the alliteration theme today.
I like it.
But it feels like it could have been a lot worse, and we've been spared the worst, given that ISM report at 10 a.m.
I got to say, Matt and I have been having a lot of conversations, like for all of us, right, who have lived and reported during the great financial crisis, during COVID, the meltdown, and the shutting of the economy. This, even though it felt maybe a little uncomfortable at the get-go, at the beginning, I feel like it's been a lot more orderly. And we've even seen that we're off our worst levels of the day, Matt.
Yeah, absolutely. I mean, overnight, when I saw the Nikkei open down more than 10%, I started to get really worried. And this morning was rough because futures were worse than they were on Friday. And then we opened down more than 4% on the S&P, down more than 5% on the NASDAQ. But you're right, Scarlett. When we got that ISM number, it kind of equalized things and we felt a little bit better. Even though the numbers are still bad, they're not nearly as bad as they were.
Yes, but, or yes, and, I think I have to say, yes, and. I've been harping on this all day, the systemic funds, right? Like if you have a volatility shock and a VAR shock, eventually they're going to have to keep selling. And so I'm really skeptical that the selling is actually done yet.
And that momentum takes on momentum of its own. So it may just be a pause before the next wave of selling comes along. But for now, we can call it a day here for Monday.
Yep, we got the bells. There you have it. Volume is really high here. We're just settling out, but the S&P looks to be closing down around 3%. The NASDAQ off by about 3.4%. The Dow Jones Industrial Average off by about 2.6%. Again, volume pretty strong on this Monday, Carol.
All right. And looking at the S&P 500, folks, we've talked about it, right? Pretty broad-based selling. 482 names in the S&P 500. Lower today, Scarlett, 21 to the upside.
Yeah, let's take a look at the IMAP, which should be pretty red across the board here, because if you slice the S&P 500 into 11 sector groups or 24 sector groups, everything is down. In fact, by 24 groups, yeah, the best performing group is household and personal products, down 1.4%. So yeah, all red, only a tomato pie there today.
I love that. All right, so it made it really tough to find some gainers, but I did find a few. Kellanova up about 16%, just off its highs of the day. Top number one gainer in the S&P 500, up the most since October of 87. This as Mars considers buying the snack maker and what could be one of the biggest deals this year. Deal talks are said to be ongoing. No final decisions have been made, according to those familiar. A deal could value Kellanova at around $30 billion. That's coming from the Wall Street Journal a little bit earlier today. On semiconductor, again, another one, an outperformer, up almost 6% at its highs today, finishing the day up 1.5%. This was among the top gainers in both the S&P 500 and the NASDAQ 100. I don't know why, to be quite honest. There was some news Friday after the close of market selling, or insider selling, which would make me think it would be down, but it's not. We did see the stocks briefly turn positive in today's session, so it could be that there was just some momentum, some buying, and pushing some of these names higher. And Advanced Micro also higher, another of the semi names, up about almost 2% in today's trade, Alex.
Yeah, we still have some earnings that are coming out. I mentioned CSX. The earnings came in right in line, a little bit better actually, at 49 cents a share. The estimates were for 48. Revenue bang in line with estimates, 3.7 billion. I was just kind of strolling through the press release here in terms of the performance to see kind of what was growing, where the risks were. It doesn't seem to have that kind of color yet, but we'll definitely keep looking on that in terms of their outlook. I know that their operating income looked to decrease about 1% versus the same period last year, but nonetheless, relatively solid results from CSX.
Okay, we also have earnings out of Avis, and of course, course, the car rental company. This is a stock that's really declined a lot this year, down about 52%. Second quarter revenue missing the average analyst estimate, $3.05 billion. Analysts were looking for $3.14 billion. International revenue also lighter than anticipated. America's revenue lighter than anticipated. There's a theme here, obviously. And adjusted EBITDA down 71% year over year, $214 million. Analysts were looking for $254.7 million.
All right, we're caught up on Avis earnings now. Take a look at some of the losers in today's market. Much bigger company, NVIDIA, was at one point down like 15% and had lost almost $400 billion of market cap. So this 6% loss doesn't look as bad as it could have been. Nonetheless, obviously, it is at least one of the two world's biggest companies. So a huge drag on the S&P. Apple as well. The Apple story, I think, is fascinating. Warren Buffett has sold, we found out this weekend, entirely half of his Apple shares. He still has a massive position. In Apple, like 400 million shares. But and Apple had rallied up into the end of the week, but that story hurt Apple shares considerably today. Again, not as bad as they were this morning, but we're still closing down significantly on what is a very large company. And then I had a look at, Robinhood and Bitcoin and Coinbase were all down because of the underlying asset. I'm guessing you can trade Bitcoin and Robinhood. It hurt that platform. You obviously trade Bitcoin on Coinbase, and it hurt that platform, bigger stock as well. But in general, Bitcoin has been a risk indicator. So with this huge risk-off feeling pervasive in the market, Bitcoin at one point was down like 16%. I think it's down right now about 9 or 10%.
9%, yeah.
And that is hurting anyone who's related to it. MicroStrategy also a big loser in the market today.
All right, I'm taking a look at the bond market. It looks super boring right this second, but man, was that a day for bond traders.
What a turnaround.
So, I mean, really, at one point, you had the 2-year yield down 20 basis points, and now it's up by 1 basis point. At one point, you had the curve disinverting and holding around 2 basis points, and then all of a sudden, now we keep inverting. I mean, that is a tremendous move in the bond market. We get supply later on this week for sure, but nonetheless, I mean, I don't know what to make of that price action.
10 a.m. ISM services coming in better than expected. Everything is above 50, which signals growth. Not tremendous growth, but above 50 does signal that things are not contracting, and that's the biggest part of the U.S. economy.
Which kind of feels like the environment we're going to be for, the next month or so, until we get through Jackson Hole, until we get to the next Fed meeting. Jay Powell reminded us, there's a lot of data points to get through, so you do wonder about how that kind of shapes the trade and whether or not we continue to see more momentum, at least on the yield curve, to the downside.
All right, let's get some numbers here on Palantir, because that is also coming out with earnings. So just the big headline here, on a full year adjusted operating income basis, they're looking at anywhere between $966 million to $974 million. They were at some point looking for about $882.9 million. So they're raising their full year adjusted operating income. Remember, this company has kind of two businesses, really. It's a government revenue-based contracts, and also they're trying to ramp up their commercial business as well with their artificial intelligence platform. So this feels like, okay, AI, I can make money from it.
Well, plus, if they get J.D. Vance into the White House, what an amazing coup this would be for Peter Thiel. I mean, the stock's already up 40%, but imagine the government contracts they could be awarded after that.
Yeah, well, the company was co-founded by Peter Thiel in 2003, and this is definitely part of the appeal of a company like this, all the recurring revenue that it gets from the U.S. government. One thing we should note is that Palantir says AI has transformed its business. Already transformed is the direct quote here. And of course, what people will want to get is the color here on exactly how much of a contribution AI has made to the business.
All right, we're looking at Lucid earnings as well. And if you're sitting at home trading this company, let me give you the headlines. The EBITDA loss, or the loss before taxes, interest, and depreciation, was $647.6 million. We were looking for $560.9 million, so worse than expected. However, the revenue in the second quarter was $200.6 million, and we were looking for revenue of $185.8 million. So the revenue was better than expected. Of course, it's really all about liquidity with this company. Does it have enough cash to stay in business? And so far, it looks like they do, because the Public Investment Fund is making a new $1.5 billion commitment for Lucid. That has got to be good news, I would guess, for the shares.
They poured a lot of money into
up about 6%.
Yeah,
up about
they've
6%.
already put $3 billion into it.
All right, Hims and Hers also out. Hims and Hers Health out. Stock is a little bit lower here in the aftermarket. I'm going to go right to the outlook. Third quarter adjusted EBITDA of 35 to 40 million. The estimate on the street is 33.8. So it does look like that's a beat. Fiscal year adjusted EBITDA of 140 to 155 million. That is an up forecast. It had seen 120 to 135 million, but the stock, which has been a real outperformer, up 100% so far this year in 2024, kind of kicking around right now, up about 0.8%. All right, guys. Whew. Monday. That's a wrap.
That was a day. That was a day.
That was a day. Can't wait to see what Tuesday brings. That's a wrap. That's going to do it for our cross-platform coverage of the market close on radio, TV, YouTube, Bloomberg Originals. We will see you guys again, same time, same place tomorrow.
Coming up on the close, more analysis on the day that was. Mohamed El-Erian, he's a Bloomberg opinion columnist and president of Queen's College, Cambridge, will be joining us to give us his perspective, not just on today, but what's in store for this week, this month, and this year. This is the close on Bloomberg. Welcome back to The Close. I'm Scarlett Fu.
And I'm Alex Steele. What a day it was. Let's give you some of the highlights here, guys. You got the S&P falling the most in September of 2022, but you know what? It could have been worse, closing just down about 3%. We were off the lows as we headed into the close. The futures market pretended it could be a much rougher day. Same with the VIX. Yes, we're at a 37 handle, but we were at a 60 handle. However, how quickly we moved in that inversion, very severe. A week ago, we were at 12. The 210 spread now down by 11 basis points. At one point, we were relatively flat. The first time we've seen that in years. Again, historic moments. And gold spot down by about 1.5%. I want to point that out because when you have to sell things either for liquidity or stop losses or to cover your yen carry trade, you sell the stuff that's been working. And gold has been working, and it did what it's supposed to do. You sell the stuff that wins in order to cover the stuff that doesn't. But gold still, nonetheless, sitting at $2,400 an ounce, Scarlett.
Well, two stocks that have been winning for a long time, definitely on the losing side today. NVIDIA and Apple were the two most actively traded company stocks by value. NVIDIA, of course, the poster child for AI excitement or hype, depending on your point of view, down on a report that its latest AI chip is going to be delayed due to design flaws. On top of that, there was another report that co-founder and CEO Jensen Huang has been offloading some of his stake in the company, selling $323 million of NVIDIA shares in the month of July, just before the tech rout really got underway. So interesting timing. No one is saying it's connected, but it's kind of an aside to what's going on. And Apple losing almost 5% on the day. There is a theme here in terms of prominent investors unloading some of their stakes, because Warren Buffett's Berkshire Hathaway has reduced its stake in Apple by half. Still a big shareholder, still holding the stock, but reducing its stake by half, probably a valuation play at this point. Kellanova, I wanted to include because it's up 16% on the day. The snack maker, remember, was spun off from Kellogg's. It jumped on reports that Mars, the privately held candy company, may buy the company. So we'll keep an eye on that one. But our top story this hour really boils down to, did the Fed make a mistake by not cutting rates? Swaps traders seem to think so, because on Friday, they priced in 100 to 125 basis points of easing following that weak jobs report. This morning, they were even more convinced and briefly priced in a 15% probability that policymakers would make an emergency cut before the Fed September meeting. That positioning did fade after a better than expected read on the services sector about 30 minutes after the markets open.
But nonetheless, it's a very transformative few days for the market. So joining us with his take is Mohamed El-Erian, president of Queen's College, Cambridge, and Bloomberg opinion columnist. And he joins us now. You were on Bloomberg Television on Jobs Day, but now you've had like 48 hours of market action. And we'll get to the Fed in just a second. But what's your bigger takeaway here on what we've seen in the markets?
So on Friday, it was all about the growth scare and the policy mistake concern. Growth, it turns out, has been slowing much faster than people anticipated. And then there was an understanding that the Fed had missed a golden opportunity to cut rates. What we've seen today is the third leg which is really bad technicals being triggered, and the concern that these bad technicals would feed back onto the economy. So we are in a situation where markets have overshot, especially in the fixed income side, especially on government bond yields. And what we need now is for these markets to regain their footing. It doesn't mean, Alex, that the Fed should do an intermediate cut. That would be a big mistake, in my opinion.
I'm interested in hearing your thoughts further on the bad technicals feeding back to the real economy. Does that happen? Is that how it works, that bad technicals can feed back to the economy?
Yes, they can, and that's the nightmare you want to avoid. Bad technicals basically means certain people have been caught off sides, and you have over-levered situation, the Japanese carry trade being one of them, and you have overhyped valuations. So what tends to happen, and you said it, is that as people try to get back on side, they sell what they can. Mm-hmm. And when they sell what they can, you get what's called contagion. And that contagion can start entering the credit market, can start going into different segments that make borrowing harder, that make banks more prudent. Mm-hmm. And next thing you know, you've got the technicals leading to a credit crunch that then undermines the economy. We're not there, but that's the one thing to keep an eye on.
So are we going there? Because in some ways, Mohamed, it would not surprise me tomorrow if we come in and we get a turnaround Tuesday, right? But are we headed there for this kind of contagion, though?
I don't think so. Look, a lot will depend on how margin calls are met today and tomorrow. You know, whenever you have these massive movements, the first thing you got to figure out, where was the pain trade and who is really having trouble raising cash. So far, we haven't seen evidence of that. So I am of the view that we will look back on this and say it was an overreaction in certain parts of the markets. Mm-hmm. And the market got carried away by demanding intermediate cuts, by demanding 75 basis points in September. It's not going to happen. It's not going to happen. The Fed will look at the economy and say, yes, it's weakening, but this is not an emergency situation, right, such as the ones we've seen before.
Okay, so things might not have gotten disorderly in U.S. trading hours, especially given the price action. You look at the charts, we've definitely closed off our lows, and things held pretty steady after the 10 a.m. ISM services report. Can we say the same thing about what happened in overseas trading in Asia, in Europe? If you look at the Nikkei, it fell as much as 13%. It closed down 12%, the biggest one-day drop since the 1987 Black Monday. If there is difficulty for companies to get out of positions or investors to get out of positions, and they have that forced selling scenario that you were just describing, that can spread to the U.S. markets, can't it?
Yes, and we're keeping a very close eye, all of us that are interested in this, on Japan. There's two dynamics going on in Japan. The one is the equity market. Remember, Japanese equities were the darling of investors up to July. And we saw a massive increase in valuations. And then you got the higher interest rates. Then you start getting the strengthening of the yen. And that meant that Japanese stocks have given up all their gains. Now, there's a completely different dynamic, which is the Japanese investors for years, has been going outside Japan to get yield. Yields were too low in Japan, so they went and started buying U.S. high yield, U.S. investment grade. And some of them have been caught offside, and they have to sell their positions. Mm-hmm. So those two dynamics are interacting, and we've got to keep an eye on that. The Japanese authorities, I think, are quite aware of what's going on there. So I suspect that you will see them provide a lot more scope for certain Japanese investors not to panic sell.
Well, does the BOJ, does the government, I know that they don't want a super weak yen, but do they want the kind of reversal that we've seen in just the last week, where we've moved from like 160 to 143 in a very short amount of time? That velocity, is that a good thing?
No, I mean, no country wants to see its currency move by this much in such a short amount of amount of time. No country wants that. This is the behavior of a an emerging economy. This is not the behavior of a developed economy with mature institutions. So no, I think they are worried about the volatility that's going on in the FX markets right now.
All right, Mohamed El-Erian is president of Queen's College, Cambridge. He is sticking with us. There's a lot more to discuss with him, whether it's overseas, whether it's here in the U.S., especially when it comes to how the Fed proceeds next. But Alex, there is still more earnings rolling in.
Yeah, we have Spirit AeroSystems coming in. Of course, this is the company that Boeing is trying to buy because it's its main supplier. The stock is just up barely, but it wasn't really great. I mean, you're looking at revenue was a little bit of a miss, $1.49 billion. You also had delivery delays, shipset deliveries for Boeing were down 42%. For Airbus, for the Boeing 737, they were down 64%. And their loss per share was $2.73.
Yeah, so this is an ongoing story, and of course, it's going to be absorbed by Boeing at some point. We will continue to keep you posted if there is any further developments there. This is Bloomberg. Today's sea of red price action in risk assets had traders convinced that the Federal Reserve will cut interest rates sooner and more than what they had priced in last week. Mohamed El-Erian, Bloomberg opinion columnist and president of Queen's College, Cambridge, is still with us, and he says the Fed is not going to make an emergency rate cut. Mohamed, can you elaborate on that? Because we went from this narrative of no landing for the economy to a soft landing with the weaker batch of data, particularly the jobs report. And now I feel like over the last 24, 48 hours to a hard landing. Where are we at in terms of the actual economy and how the Fed responds?
So I don't think we're at a hard landing. I put the probability of a hard landing at 35%. That's where I've been for the last few months. The market is adjusting towards 35, and in some cases, people have gone into above 50. But for me, it is not the dominant scenario. Yes, it's a fat tail. Scarlett, you get emergency cuts when you have a massive external shock of some sort. You don't get emergency cuts simply because you've had 3 data releases that were weaker than anticipated, right, and you've had market turmoil.
I mean, that's what was confusing to me, Mohamed, because the jobs number wasn't terrible, right? Like, we weren't negative jobs. So that's what was very confusing. Is this just the market testing the Fed then?
Yeah, I think the market is trying to replay the fourth quarter of 2018, where you get unsettling volatility, and that unsettling volatility forces the Fed into a U-turn on policy that's not warranted by economic developments. Now, it worked in the fourth quarter, but it didn't result in an emergency cut. It just made the Fed less hawkish at its next policy meetings. And that's what I think you're going to get. You're going to get either 25 or 50 basis point cuts in September, but you will not get an intermediate cut.
How much is the market doing the work for the Fed in terms of tightening? Let me rephrase that question. Financial conditions are tightening here. How much does that change how the Fed responds to what's happening in the markets? I know you said unless there's true turmoil or unless there's an external shock, but the tightening and the extent of the tightening that we've seen in just the last 3 days alone is pretty remarkable.
So you've got two competing factors. You know, the interest rate risk factor and the equity stroke credit risk factor. So the interest rate one is loosening tremendously.
Yeah.
We had a 50 basis points move in the 2-year last week. That doesn't happen in a mature economy. We had 50 basis points move.
Yeah.
So you've had a loosening of financial conditions on the interest side, but you're right, you're getting a tightening of financial conditions on the credit and equity side. So, you know, how does it play out? I suspect they're pretty equal. Keep an eye on credit spreads. Credit spreads have been relatively well behaved so far. They haven't adjusted the way treasury yields have adjusted. So just keep an eye on credit spreads, because that's going to be really important.
Mohamed, we just have about like a minute left, but you know, the Fed really set up jobs data as being the it factor. What's going to be the it factor for you over the next few weeks?
So I think all of us are going to start paying attention, a lot more attention to jobless claims on Thursday. It's a noisy number. It's a very noisy, high-frequency number. But if that number comes at above 250, then the market will get really nervous about the recession risk.
All right, so watch for 250 on jobless claims. And right now, the consensus estimate for this Thursday's report is for 240,000. So we're getting closer to that level. Mohamed, always a pleasure speaking with you. Please come back and join us again. Mohamed El-Erian is president of Queen's College, Cambridge, giving us his perspective on what has been a pretty incredible Monday. It feels like we've gone through a war, even though at the end of it, it wasn't as disorderly in the U.S. trade as it seemed in Asia trade.
Yeah, I feel like aside from the fundamental economic data here, just the jostling of positions when you have a VIX now at 38, I feel like a drum beat here. But all those funds that have to readjust their risk, I can't imagine it's done in just 48 hours time.
Yeah, well, I mean, a big driver of all the volatility and the declines and the weakness is certainly technology stocks. And coming up, we're going to speak with Dan Ives, senior equity analyst at Wedbush. He's going to break down the latest AI company to report, which is Palantir, but really talk a little bit about the perspective of these companies and what kind of long-term view you need to hold for some of these AI-related plays.
Also, NVIDIA getting hit as well, and some production delays. Dell also reorganizing, all of that filtering through in the tech market. This is Bloomberg.
This is Bloomberg's The Close. I'm Scarlett Fu. Shadali Bassick joins us now through the rest of the hour. And I know you've been doing double duty today. You were there for the open when things looked really bad. And since the 10 a.m. ISM services report, things have calmed down a little bit in that it didn't get worse.
They certainly have calmed down a bit. And yes, it didn't get worse. Interestingly, the bond market did reverse pretty significantly. You have to wonder how that sets up for tomorrow, doesn't it?
Absolutely. We also, of course, had earnings after the closing bell. And Palantir is one of the companies that did report. And so far, we're looking at a double-digit percentage gain for Palantir. It increased its profit outlook. It also, of course, talked up its AI business as well, saying that demand for AI is definitely helping its business. It says AI has transformed its business, in fact, with revenue climbing 27% thanks to its commercial business. And, you know, of course, AI plays a part in Palantir's business with the U.S. government, that recurring government contract that it has benefited from.
Certainly a defense name here. It was also a Trump trade, might I add, as well.
Good point.
Also a stock that before you entered today was just taking a massive hit. Boy, what a day makes.
All right, so let's bring in Dan Ives, a senior equity analyst at Wedbush, to give us a little bit more context, not just on Palantir, but on the big tech stocks overall, which I know that Dan is pretty constructive on. Dan, when it comes to Palantir's results, how low or high were expectations heading into this? Janali mentioned the fact that the stock had been under pressure, but this is a company that has some very, very stable contracts.
I mean, this was a gold medal performance. You look at what's happened on AIP, this is a company in transformation mode. And when it comes to the AI revolution, I think actually one of the best barometers around demand, besides Microsoft, NVIDIA, AMD, Palantir. That's why they're the Messi of AI. And I view this as really just a game changer quarter, not just for them, but what it speaks to about overall AI demand for the enterprise.
Dan, at the end of the day, you look at a sell-off like today, and I know that you say hold through the long term, but ultimately, how do you feel about investor sentiment around these Magnificent Seven names and anything AI adjacent at this point? Do you feel like there's a fundamental shift here and that perhaps investors are going to have to hold on a little longer here to ride out this volatility?
Look, I think this weekend is about as scary as I've seen, probably going back to like COVID lows in terms of March 2020, in terms of the hand-holding, over the weekend and today. But it comes down to look at the fundamentals, look at earnings, look at what's playing out a once-in-a-40-year type of cycle in terms of AI revolution. Look, we are going through a white-knuckle moment, whether yen carry trade, what we're seeing in Nikkei. But that doesn't change our view. This tech bull market continues to have legs. And look, almost 25 years covering tech in the street. We use times like this, white knuckle moments. We're front and center, hand holding. You own the winners. You own the names. I mean, I think Palantir is a perfect example. I mean, that stock was almost 20. probably tomorrow it has a 3 in front of it.
Okay. And I want to get back to some of the big tech names, but first of all, you mentioned white knuckle moment. You are joining us from Japan. So that means you were there yesterday during the Nikkei's decline of up to 13%, its biggest one-day decline since the 1987 Black Monday crash. Give us a sense of what you saw and what you felt. Was there panic selling? Was it disorderly?
I think maybe a little calmer than you'd expect, from just the historic sell-off. But no doubt, I mean, this was more than a white knuckle moment, historical. Just happens that I'm here. But it comes down to, when things like this happen, we're not going to hide. How do you ultimately, what does that ripple effect look like, not just for Japanese funds, but around the world? And I continue to believe this is just more of a global sort of, whether it's a yen carry trade de-risking, that will stabilize and will create opportunities, but definitely not time to be having a cappuccino during meetings in Tokyo.
Dan, but at what point do you say hold off here on catching the falling knife? Because if you don't know how far the carry trade has to unwind, and then you layer the systematic traders on top of that, at what point do you worry that we just have more to go here in this white knuckle moment?
We could have more to go, right? But my view, and it's always been on these panic geopolitical VIX spiking moments for decades, that's been our best opportunity to own the best tech winners playing the core tech themes. And to me, what would make me hesitate if fundamentals change, if our checks here in Asia don't show the demand for AI. If we start to see that, then that's different. It's actually the opposite. And I think we'll hear that from NVIDIA in a few weeks and the rest of tech. But look what we saw in Microsoft. Look at Lisa Su AMD. Look at Palantir. Look at what I think we're going to see with NVIDIA. You don't look at disasters like Intel as a barometer.
Okay, you mentioned NVIDIA, so I'll bite. NVIDIA shares declining a lot today, of course, pairing a lot of their losses, but there was a report that its upcoming AI chip is going to be delayed because of design flaws. How meaningful is this delay to its revenue line, to its bottom line, at a time when investors are in a show-me kind of mood?
I don't think that really changes the story. I mean, if it moves a few months, no one's stopping orders because of it. It comes down to demand. Timing, things could shift out a little like we've seen with tech. I mean, you're going through a generational type of tech move, obviously led by Godfather of AI, Jensen, NVIDIA. This doesn't move the needle, but it goes into the perfect narrative of just the perfect storm weekend besides geopolitical, the Nikkei, yen carry trade, Buffett selling half of his Apple position. This just kind of adds fuel. And that's why all the bears, I was getting worried, I hadn't seen them in 18 months, they all came out over the weekend.
It's interesting. If you take a look, and you mentioned that you were in Japan, when you see the Japanese indexes and how much they fell coming into this morning's trade, it was drastic. They were historic moves to the point that you're making. If you look at the NASDAQ 100, it was like a roughly 3% drop off of 2 days of more than 2% drops in a row. When you're talking to clients out there, Dan, what's the sentiment and what's the worry that risk-off appetite starts to be more pervasive around the world?
I don't think, especially on an institutional perspective, who's going to be wanting to sell Microsoft, Apple, NVIDIA, Tesla, Alphabet, because of a yen carry trade falling apart in the summer? The point is that these are situations. I'm not saying that it's pleasant.
But isn't that what happened, Dan? Isn't that what just happened the last 24 hours?
Yeah, and that's why as a tech investor, you view that as opportunity, not time to hit the elevator and hit the exits. I think the best ones over the years, they've been able to use these opportunities. But it comes down to fundamental.
Yeah.
Look at earnings season and look at Palantir just as another data point that this AI revolution is still in the second inning.
I know you've put it in different ways, second inning, or it's 9 p.m. of an all-night party, but with the pullback that we've got today in the last couple of days, has the time changed to now like 7 p.m.?
Look, does music every once in a while go out at the party? Yeah. But it's still 9:30 in that party. And we're not, as our checks continue to show, this party's going on till 4 a.m. We stay firmly bullish. And that's why we've used opportunities like this. You go through the white knuckles, you own the names in tech, look at fundamentals. That's how we navigate.
Some people feeling hungover today, but Dan, I know you're up bright and early. That is Dan Ives, senior equity analyst at Wedbush. We're going to take a look at some of the biggest movers in after hours, after quarterly results. Lucid, Hims and Hers, Spirit Auto. A lot of divergence here after market, aren't we seeing here? Lucid up 15% after reporting. Hims and Hers down almost 10%. Spirit Aerosystems down more than 2%, Scarlett.
Yeah, Lucid, of course, getting some new Saudi support. The PIF putting another $1.5 billion of commitment behind that company. I believe Matt Miller was telling us it's already given $3 billion, so that financial support is certainly being welcomed by investors. Spirit Aerosystems, a modest move, but it is being absorbed by its former parent, Boeing. And Hims and Hers continues to be another story of consumer demand for its different drug options, which of course are sent directly to the consumer as opposed to the traditional channels.
And of the hundreds of companies that have reported earnings so far, more than 80% have topped consensus estimates. But much like the market sell-off, the good earnings news has been eclipsed by guidance from consumer and tech companies in particular. Joining us now for more analysis is Gina Martin-Adams of Bloomberg Intelligence. What do you make of all this? You have the earnings season tailing off at a time when sentiment seems to start to change and the macro along with it. What does the forward look mean in terms of kind of changing attitudes around the street?
So the only area of change to the negative has really been with respect to tech and some of the select tech adjacent names in the consumer and communication space. And with respect to that, it's not about a downgrade of the outlook. It's really about a downgrade of the excessive expectations embedded in price. So I think that that's an important nuance because we're actually not seeing company guidance to the downside. We're not seeing analyst estimates revised lower. What we are seeing is tech companies saying, hey, hold the phone. Your expectations are far too high, market, right? And I think that that's an important nuance. We need to watch, though, as the earnings season progresses to see if some of the weaker macro data that we've had in the last couple of weeks impacts the ex-tech space. And that's yet to come. We really haven't dug into the meat of the consumer earnings season or some of the industrials earnings seasons. Financials were off the charts fantastic at the start of the season. So let's see what happens in consumer industrial yet. Certainly the ISM returning back to 2023 lows is not a welcome surprise, but the services index today was relatively solid. So it's been kind of a mixed macro. Even though last week was painful and we characterize it as this horrible kind of macro week, it's been realistically a little bit more mixed.
A little more mixed, and a lot of it had to do with guidance, just simply not living up to investors' very, very high expectations. And I'm glad you bring up the fact that we still have a lot of earnings to go, whether it's consumer companies or industrial companies, and they make up a big, big chunk of the U.S. economy, even as the big tech names make up a bigger chunk of the S&P 500. When it comes to the industrials and the consumer names, what kind of comps are we looking at here for these companies? How high or low is the bar?
Yeah, the bar is actually really low. The bar is very low for all of the index except for tech. And I think that that's also important is a year ago, the rest of the index, or the 493 of the S&P 500 that are not the Magnificent Seven, were posting year-over-year declines in earnings. So that makes for very, very easy comps for this segment to potentially do quite a bit better. Very contrasted to the Mag 7 or the biggest of the big cap tech stocks where earnings growth was peaking over the course of the last several quarters. These are groups that are just starting to dig their way out. I think, though, we have a confidence issue in this space. It's not just about what the companies say, but how they say it and how they guide going forward. And the investor confidence is very, very limited with respect to this group. All of our confidence was really piled on the shoulders of big cap tech, where we did see persistent and accelerating earnings growth prospects. This group is just starting to show some signs of improvement, and investors need to gain confidence that improvement is durable.
Gina Martin-Adams, a great reminder that there are 493 other companies out there, certainly in the big cap space and even more in the small cap space. Thank you so much. And again, just to recap where we are on this Monday, you have big declines here across the board for the equity indexes, whether it's the tech-heavy NASDAQ, the S&P 500, or the Russell 2000, which had been a beneficiary of the rotation trade out of big tech into smaller companies on hopes that the Fed would soon cut rates. The VIX, look at that, Shanali, because at one point that got to somewhere in the 60s. It's come back down to 38, which feels relatively low, but certainly a long way off from where we were just a few weeks ago.
And if you looked at the NASDAQ 100 over 3 days, you're off by almost 8%. So really that 3-day basis is even more painful than the day alone. But more to come this week, Scarlett.
This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And today's theme is Kamala Harris's potential running mate, who she's considering as her pick for VP. First up, Mark Kelly, former astronaut and U.S. Navy captain. He's been serving as a junior senator from Arizona since 2020.
And next up, Josh Shapiro, the popular governor of Pennsylvania, which is, of course, a key battleground state.
And finally, Tim Walz, the Minnesota governor since 2019. He is credited with being the first Democrat to call the Trump campaign's activities weird. It's a label that seems to have gained some traction because you've been hearing a lot of people use that word to describe what's going on with Trump and Vance and everything else there. All right, Kamala Harris expected to announce her choice by tomorrow, but Reuters is now reporting that she has narrowed the search down even further. So, of course, we needed to bring in Balance of Power co-host Kailey Leinz to give us a little more context here. So, Kailey, she's narrowed it down from 3 to 2. What's your money on? Or who is your money on?
Well, at this stage, it really is just a binary choice. According to Reuters, it's two governors, Governor Walz of Minnesota or Governor Shapiro of Pennsylvania. Now, if you're just going via electoral college considerations, you could understand why Governor Josh Shapiro of Pennsylvania would be the more attractive choice, considering that he is very popular in that state. He's a governor with north of 50% approval ratings. And of course, if you win Pennsylvania, that really helps you on the path to 270 electoral college votes. Remember, there's 19 electoral votes, college votes in the state of Pennsylvania, and this is a key pillar of the so-called blue wall, which includes Pennsylvania, Michigan, and Wisconsin. That said, that is in the same neighborhood as Minnesota, which is why Tim Walz perhaps is on there. He's also one of these kind of darlings of the media, if you will. You mentioned that he coined that term weird. He has been making the rounds on various TV shows. He is someone who is well known in the House of Representatives, having served there for 12 years before becoming governor. So really, we expect that we'll understand which of the two it is within the next 24 hours, because Kamala Harris is set to kick off this ticket in style in Philadelphia tomorrow evening with a rally. We've been told not to read too much into the fact that that rally is happening in Philadelphia, which is Josh Shapiro's hometown, so I will let you read into that what you will. But, of course, that's going to kick off a 7-state swing state blitz with this ticket over the course of the next 5 days.
Oh, given the location, in some ways, it's hard if it's not him. Kailey, you know, when J.D. Vance was picked to be Trump's running mate, there were very obvious market implications in the sense that he has been very vocal on a certain number of topics here. If you had Josh Shapiro or Tim Walz in particular, what could you expect out of them? Will it be as significant for Kamala Harris as it would have been for Trump to choose a running mate like he did?
Well, one of the threads here that actually runs through both the Republican and Democratic side is the idea of appealing to labor. This is something the working man, we heard J.D. Vance talking a lot about after he was selected as the Republican vice presidential nominee. And it is worth pointing out, we have heard from labor about Governor Josh Shapiro, including from the UAW president Shawn Fain, who was not in favor of him as a choice. He actually preferred someone more like Governor Walz or even Governor Andy Beshear in Kentucky, who they viewed as pro-labor. Labor also had a problem with Senator Mark Kelly of Arizona, which could potentially play a role in the fact that we no longer understand he is on the shortest of short lists. So labor policy is going to be something very interesting to watch, especially considering Harris is planning to be in Detroit on Wednesday to rally with the UAW. But something else to consider here on policy is Josh Shapiro when it comes to Israel and Gaza. We know that this is a problem that has very much divided Democrats between progressive and more moderate Democrats. Josh Shapiro is a Jewish man. He would be actually only the second person in history to be on a major presidential ticket who is Jewish if he is indeed tapped. And he was much harsher in handling some of the college protests we saw earlier this year that has caused some problems among progressives. So that's another area to watch very carefully if he is ultimately selected by Harris.
Okay, so the moment is tomorrow evening in Philadelphia when she holds her campaign rally, but there's a possibility she'll announce it before then, or?
Yeah, it is worth considering that when Biden rolled out Kamala Harris as his vice presidential pick in 2020, it was a video on social media that went first. Granted, it was during the pandemic during that time, but we have heard rumors that it could be a kind of video rollout that begins the proceedings, if you will, tomorrow, and ultimately, of course, culminating in that in-person rally.
Amazing. Thank you so much. Bloomberg's Kailey Leinz, co-host of Balance of Power, on a lot of news coming out of the Kamala Harris campaign soon. Still ahead, what investors need to watch for tomorrow, starting with more earnings. This is Bloomberg. And take a look at what else we're watching for tomorrow, because in addition to Uber reporting earnings, Shanali, Caterpillar, which kind of kicks things off for the industrial companies.
I am very excited. Another bellwether to look forward to before the market opens tomorrow, as well as Hyatt. Remember, watching how Hyatt, Airbnb, all these mobility companies and companies focusing on travel are really interesting in this market with that weakening consumer.
Absolutely. Reddit as well is going to be reporting earnings. There's also some economic data, although having said that, the most important economic data point really came out today with the ISM services. There is trade balance, doesn't tend to move the market as much.
Listen, we're all waiting for Thursday at the end of the day with the jobless claims. But yes, we are keeping an eye on every economic data point these days with the bond market moving as it is.
All right, and let's not forget that tomorrow evening, Kamala Harris is holding a rally in Philadelphia. And everyone says not to read too much into the location, given that Kamala Harris still hasn't selected or named publicly her running mate. But there's a lot of anticipation that her running mate may just be the current governor of Pennsylvania.
And like Kailey was saying, really, this announcement can come anytime tomorrow in any form. Social media has stolen the show when it comes to this election. Let's see if we'll hear sooner. But of course, this is really the political news of the week.
Yep, and of course, with her rally in Pennsylvania, she's going to kick off a 7-state campaign rally overall. So she's going to be on the road a lot here. That does it for us. We've got Balance of Power coming up next with Kailey Leinz and Joe Matthew. Have a great evening, everyone. This is Bloomberg.